Unlock the high returns of the expanding venture capital world right here on the Emerging Managers Podcast.
Scott, we went to the heart of the country for this episode, this interview. Patrick Henshaw, Render Capital, Cincinnati, Ohio.
Yeah, great, emerging, manager. In fact, he's not even emergency, although he's a smaller fund. He's in the top quartile in terms of performance. And that was really the whole thesis of putting this together is these monolithic funds just can't get the returns that these smaller, nimble niche funds can accomplish.
Yeah, I know that top 25% of VCs. I was like, when he said that, I was astounded by that. And leading $150 million venture fund, like that's just with partners like Procter & Gamble, Kroger, like big name partners, which is how you can build that size fund.
Yep. Yeah, he's really built a great network of LPs that are not just money, but money and relationships, money and opportunities. And I think when you deal with investors from these major brands, you get a lot of good insight, and you get a lot of good extra opportunities in addition to, being an investor.
Well, and I also love that he's a veteran. He's a West Point grad, airborne ranger. He's served his country, served all of us. And
I think that's really good because the reality is, veterans, are always need a beacon of what they can do after they serve our country. And, this is a great demonstration of what you can do after you serve.
Not just that, but the discipline required, all of the things that are required to build a great company, a great foundation. He's a great role model and mentor for the investments in his fund.
Absolutely is. Absolutely. He's doing some really good things in the second part of his post-military career.
I love that. Well, let's hear from Patrick Henshaw, Render Capital.
Well, hello and welcome to the Emerging Managers Podcast. My name is Scott Kelly. I am the founder and CEO of Black Dog Venture Partners and the host of today's podcast. And I'm excited to introduce one of our emerging managers on the show, Patrick Henshaw of Render. Patrick, share a little bit about yourself personally and then maybe what you did prior to starting the fund.
Yeah, sure. So feel free to take me down any rabbit holes or pull me back up because even though I've not been around this earth for too long, coming up on 40 years, I've had quite a bit of a journey. Yeah, I grew up in Houston, Texas, and knew I didn't want to be in Houston for forever. Grew up in a great, loving family home, but not necessarily in a great neighborhood. But my way out was through the military. And I knew I wanted to be a civil engineer. So went to West Point, got my master's in civil engineering from Norwich University. Little known fact, West Point was the first public engineering school in the nation, 1802, and Norwich was the first private engineering school in the nation in 1812 is when they were founded. Did everything in the Army from looking for roadside bombs in Afghanistan to Ranger, airborne, air assault, explosive ordnance, all that kind of fun stuff. And then lived in Germany for a little bit and then came back stateside to be the executive officer aide-de-camp for two-star generals in the Corps of Engineers, and then helping them and the organization manage about $36 billion worth of infrastructure assets. And that's really, honestly, where the middle of America came alive for me because so much commerce is dependent on the unique asset that the middle of America has, which is the Mississippi River Basin, right? We're the third largest watershed in the world, and it allows us extreme dominance in transportation of goods at a cheap cost. So coal, food, everything and anything, bulk transit goes along the Mississippi River. So got out of the military from the booming Civil War town of Vicksburg, Mississippi, got recruited by the Bechtels and McKinseys and, all these kind of things. But I got out of the military because of and my love, I would not change anything, but my love and distaste for the bureaucracy and lack of meritocracy. I was doing the same thing that the same, 20, 30-year-olds were doing, getting paid the same rate. And they were, pushing papers, and I was managing billion-dollar programs. With a little bit of frustration in there. I was a professional engineer, PMP, Lean Six Sigma, all this black belt, all this kind of fun stuff, and tried to move things forward. But instead of 2 stars on my chest as the general, I had 2 bars on my chest because I was a lowly captain. So did what every entrepreneur who still can't spell that word today did or does as I got out and I became an entrepreneur. So built and exited 3 different companies. The first 2 were bootstrapped, using VC terms. So we used revenue from our customers to grow. We had offices in Vicksburg, Mississippi, and Florida, did a bunch of work in DC and throughout the globe, really. And then third business was venture-backed. It was in the human data analytics space. So we were one of the first providers. Shout out to Eric Makovsky, the founder of Pebble, who's bringing Pebble Watch back after they sold and Google open sourced it. But we were one of the first analytics providers there, and among 100 different other devices, worked with everybody from Procter & Gamble to Red Bull to Veterans Affairs to anywhere and everywhere in between, helping people understand more of this kind of quantified self-movement in and how and where they went. Got a couple contracts with an Australian life insurance firm, and ultimately exited that business from there. And in 2015, 16, I moved from San Francisco to Cincinnati at the behest of one of my angel investors, who got tapped on the shoulder by another West Point grad, a guy named Bob McDonnell, Secretary Bob, as he affectionately likes to be called, because he left Procter & Gamble to be the Secretary of the VA. And so Wendy, who I met in San Francisco, she was an early investor in us. She got tapped on the shoulder to be the CEO of a fund of funds in Cincinnati. And Wendy and I and the team there grew that from about 30 million under management to 150 million under management. Our investors were Kroger, Procter & Gamble, GE Aviation, Michelman, St. Elizabeth's Healthcare, Children's Hospital, Mercy, now Bon Secours Mercy. And we had 2 types of ROI that we were producing. One was a return on investment. We were investing in top tier, early stage, top quartile fund managers like the Lear Hippos and Madronas and SV Healths and Mercury funds and founder groups and things like that. Then on the other side of the house, we were driving corporate innovation by connecting the Procter & Gamble's to not only portfolio companies, but to also those general partners to help them unlock innovation and innovative ideas. And then coming up on 6 years ago now, saw the figurative and literal blue ocean here in Kentucky, as you can see from my background. And we were colluding earlier, Scott and I, about the bourbon in the background. But I said, when in Rome, act like the Romans do. So moved down here, launched Render, and now we've managed over $30 million worth of capital. Our traditional venture fund, $15 million fund, is, I'm happy to report, we haven't gone public with this yet. Scott, you might be the first to get this news, but we're top quartile. Yeah, we're top quartile, which means we are in the top 25% of all global venture capitalists in our peer group. So very, very excited to be here, and thanks for having me on today.
Thanks, Patrick, and thank you for your service. And it's interesting you mentioned Cincinnati. My brother is a chef and very well known for a restaurant he ran in the Hilton Hotel restaurant. He's the executive chef, and it was the only restaurant in the entire state of Ohio that I think was a 5-diamond restaurant. So
that's awesome. We love that place. So tell your brother thank you. And it was a hot spot back. My startup went through the Brandery, the nationally ranked startup accelerator there, and we were incubated at Kroger's 8451, their digital innovation or their digital analytics company. And every burger week we would hit up the Hilton. Not just because the good food was good, but also the burgers were great.
Absolutely. Well, thanks for that background, Patrick. Maybe dive a little bit more into Render. What's your investment thesis? And what brought you to what you're doing? Where you're investing today?
Sure. Yeah. I think if we just back all the way up and out, we invest in early stage, high growth companies beyond traditional tech hubs, San Francisco's, New York's, the Boston's, really in spaces and places we say that makes sense for the Midwest and the South. So you would call us a generalist, right? But from the inside, we invest in things like healthcare, health tech, supply chain logistics, advanced manufacturing, consumer packaged goods, e-com, food and bev, and of course, business to business SaaS. And a big reason for that was not only my exposure as a founder, multi-time operator, but also at the fund of funds level at Centrifuge. There are so many companies in the Midwest that have just this propensity to win with the three-legged stool that we call or have found to be success for startups, which is customers, capital, and talent. Right. If you look at each of those industries, healthcare, health tech, right? Louisville, just in our own backyard here, 12 or 13 of the top executives, if you pool all of their spend, that's about $100 billion a year in annual spend in healthcare and health tech. If you look at supply chain logistics and even CPG and e-com, we've got UPS's global air hub here. By the way, my wife is an amazing entrepreneur and superstar. She's built and sold 2 companies, first to a publicly traded company, second to a private equity backed company, led Procter & Gamble's innovation arm. And she just bought a middle market company in warehouse and logistics about a stone's throw away from the global logistics hub here because of that point of difference, right? Mm-hmm. And then we've got FedEx's global air hub. We've got Amazon's prime air hub, 45 minutes north of us, just south of Cincy in northern Kentucky. So each one of these areas that we choose to invest in are very specific for those reasons in the region because of customers, capital, and talent. And I would say for us, you ask why me, why here? I think the biggest thing for me is because when I got out of the military, I didn't have a support network. I didn't have other founders that I could lean into. I literally picked up the phone, being from Texas. Obviously, UT Macomb School of Business is a top-rated, business school. I called them and said, "Hey, I'm a veteran. Spent a bunch of time getting blown up. I'm okay, but I want to start a business." And so they were incredibly helpful in saying, "Hey, here's the ropes. Here's how to get things started." And we take that same, mantra today. We serve on the boards of our companies. We're very active in not only the companies themselves, but also getting them to the next level. And a lot of that has to go back to the network and the scale and the speed at which we help companies grow. So that's really the biggest kind of why behind it for Tret, our principal, and myself.
No, I definitely, I track with that. I spent time in both New York and in Silicon Valley. And, the reality is there's talent throughout the country. And in all frankness, the valuations are probably better in the Midwest.
Totally. Scott, you hit it on the head. So this is so interesting. We came up with this thesis pre-COVID, but really you can even see the shifting dynamics. Now there's still a ton, like 80 some odd +% invested in New York and San Francisco and Boston. But to your point, really synthesizing that down is you can be more capital efficient in the Midwest. Right. When I lived in San Francisco, I lived in, I slept on a twin mattress underneath a stairwell in a 7-bedroom house where I was renting that one room and my rent was $1,200 a month. And this was 15 years ago. I mean, it's absolutely berserk, the cost of living.
You're absolutely right. So I spent the last 20 years prior to moving to Florida in Arizona. And we would incubate companies in Phoenix, and then we would move them to WeWork on the Embarcadero, and we'd get immediate double or tripling of the valuation just for the physical location. So
yes, it's crazy.
So you mentioned obviously you're a veteran, and you mentioned obviously your average of veterans. Maybe you could share a little bit, what attributes would a veteran be in a company you might want to start up or a company you might want to invest in?
Yeah, I think at the top level, coachability and understanding frameworks. So from the very earliest days of West Point, and I'm just going to assume leadership is automatically thrown in there, because from the earliest days of West Point, not only are you taught leadership, but you're taught how and where not only to be coachable, but to coach. And that's the biggest thing that I think, founders, especially in a high velocity, high momentum environment, their number one job is to synthesize all these different data points from the market to customers to board members to investors to, users, whatever way, shape, and form, and synthesize that into an area where they take direct and specific action and cast that vision for other folks to come along behind them. Right. And I think it's really interesting because, Elon Musk this past week was at West Point as a part of this West Point speaker series. And one of the professors that was interviewing him talked really about the juxtaposition of NASA and SpaceX and the speed at which SpaceX has moved relative to NASA. And I think a big piece of that is really that visionary complex and mindset, and say what you will about Elon Musk or whatever, but that guy can rally the troops, right? And he can bring folks behind him. He can cast a vision, and he can cast what we would say in the military is commander's intent. And the difference between commander's intent and mission is the critical aspect of winning any operation, whether it's in business or on the battlefield. That commander's intent is get across the river, right? The mission might be get trucks, build a bridge, make sure you have beans, bullets, ammo. All of that stuff can be accomplished in intent, but mission didn't say build a drone or build a rocket ship or build a space shuttle or whatever. Intent just said get across the river. So if you understand the commander's intent, you understand the vision, you allow those lower level leaders to really think flexibly and agilely about moving in that specific direction. So I think coaching and coachability, and then understanding resource allocation through frameworks, right? That's another big thing, whether you're using OKRs, objectives, key results from Google, whether you're using, Boss Up or 90, for managing rocks and those type of things. What the Army really instills is understanding those frameworks and then evaluating those frameworks against an analytical process, a data-driven approach inside what is doing good and what is doing well and what you should change and what you shouldn't change. So I think those two things, coachability, synthesizing that intent and getting that out there, casting that vision, and then using those frameworks so you can rapidly iterate and frankly, get everybody on the same page back to that intent.
Fantastic. It's we work with a number of startups, and some of the ones that are veteran owned and veteran founded tend to be the most organized. And like you said, the most coachable. I think the key is understanding what you know, but understanding more importantly, what you don't know.
100%. 100%.
So you've shared a lot about your success prior to Render. Let's brag about the Portco. Tell us about some success stories at Render.
Oh man, well, all still private companies. So I'll maybe tell some stories and leave out some of the details of companies just for their own significance and my LPs too. There's been some interesting things. Back to the valuation piece. I think when we think about Midwestern valuations, a lot of people, scoff at how and where and how low valuations are. But at the end of the day, I think there's a specific balance that you have to be at, because we oftentimes say no to founders when their valuations are too low. And more specifically, when they give up too much equity. Like I had a founder a couple of weeks ago come in, had only raised like $1 million and had given up 50% of the company already to advisors or to investors or whatever. And it's like, hey man, my number one job is to make you rich and to keep you in the game. My number two job, because of that and thereby, is to make my investors money. Right. Yep. And the only way we can do that if there's this literal and figurative capital stack. And sometimes people don't understand that that's a part of the game, right? You have to have room up top for future investors to come in, and you have to have room below so you're not cramming everybody down for those potential follow-ons or networks or connections that come into that. But that also means that you need to be specific and pragmatic about the capital that you're laying on each other. So all that said, awesome, portfolio, super proud of the companies that we've invested in. A couple winners, that I'll talk about, and had some tough decisions. There's a board meeting a couple of months back that we had I use air quotes here. We had to have a really hard board meeting because we invested in them in January of last year. So almost 13 months ago now, at a $10 million valuation. They were doing $500,000 a year in top line revenue. in October, we walked away from a $100 million all-cash offer for the company. And you might think, Patrick, you're ludicrous. Why would you do that? But they had not launched in a new fertile market, and we think the value that they're driving, that price will 2 or 3x in the next 18 or 24 months. And most importantly, the founders still wanted to stay in the game. Right. And so that's a big thing for us, is making sure that the founders not only are incentivized, but are able to stay in the game and stay in the fight, and to go after those outsized metrics and goals. I think some of the other interesting portfolio companies that we have, and I'll talk about them just because they're very, very public about what they do and how they do it. Company like Forecaster, I'm sure, Scott, I'm sure you've seen them, but hopefully half of your audience has at least.
I know Jeff. Many people have forecasted very well. So
that's awesome. Yeah, and the stuff that Forecaster is doing and helping revolutionize the financial model and helping, I jokingly but seriously say, not piss off your CFO is a great thing, right? And we love companies that are really adding value not only to other companies, but that are also really hitting things at a point in time where we're seeing the rise of artificial intelligence. And obviously, I'm going to say that word just because what's happening in the world today. I mean, it ended up in the Super Bowl ads last night for absolutely no reason in a Coke commercial.
That'll definitely help in our Google ranking. Absolutely.
Yeah, exactly. But I think the point of difference really in the companies that we invest in is that they're leveraging AI as an asset. They're not building foundational new AI infrastructure, right? That train has left the station, right? The X's and the Llamas and the Metas and the NVIDIAs and all of that stuff is great and perfect, and we need that stuff. But our companies really are putting that to use in a way, in a shape, in a place that helps maximize top-line value, but also maximize top-line revenue.
So let's talk about liquidity. Obviously, the last couple of years have been, I tell people when we talk to investors, getting money into your company is the easy part. Getting the money out is a little more difficult. Maybe kind of share where you think the market's going.
Yeah, so I think the interesting thing is we come up on, some of the highest highs that we think we're going to see in public markets. I'm not a, day trader or anything like that, but obviously we're looking at financial forecasts and understanding markets because, to your point, that's where liquidity makes sense and needs to happen. I think the really interesting thing is that the public markets, as they are targeted to come down in later in Q3 once things settle off, we think that that's going to open up acquisition opportunities for these public players. Because they're going to take some chips off the table. Maybe some of their founders are going to take some chips off the table and invest in things like Render Capital because we're a top quartile fund, right? But at the same time, I think you're seeing a lot of these larger entities like the Proctors, like the Krogers, like the GEs of the world. They have to innovate through acquisition. And even just take a look at Procter and love how and what and where they built, but their R&D folks are looking 30, 40 years out for the next billion-dollar brand, right? When they have, and I'll say this affectionately, all these ankle biter brands that are taking market share from them. Right. And I think that's going to be the most fascinating thing. I mean, you're seeing even Fidelity Investments and their group and a lot of these financial services organizations think differently about how they educate, how they train, even like unsexy stuff. Like Tret, our principal, and I were talking last week, sharing a deal, and we both looked at each other at the same deal and we're like, it's not boring enough. Like, we want to invest in stuff that's super crazy boring, but that produces outsized value. And one of the more interesting yet boring companies we have is this company called Support Pay. So back to military leadership, former Jarhead Marine, the founder Sherry. went through a divorce, grew up through Silicon Valley, post Marines, Silicon Valley exec and all these different great organizations. But she saw divorce and really the transparency and the ability to reconcile transactions at a divorcee's level, at a co-parenting level, right? Even if it's an amicable, split between the parents, the kids are caught in the middle. Right. And Johnny needs a new pair of shoes, or Susie's going to piano, or whatever inside of that. Well, what Sherry has built is the most unsexy and sexy, amazing thing in the entire world, which helps support families and helps supports driving trust, transparency, and communication, which is Render's core values. But at the same time, now they're selling through benefits plans, because something like 80 hours a month for divorced and co-parented families is spent on helping their kids and going back and forth on transactions. And what Sherry and the team have built essentially at Support Pay is like Venmo meets PayPal meets QuickBooks for co-parenting. So all on the same platform, very similar to Greenlight. If you use that kid's financial debit card, it allows you to coalesce transactions, dispute them on the platform if you think there's a dispute, but then also really make the transaction frictionless. So those are some of the things that we're excited about. And again, back to liquidity, I think, again, the important difference there is, yeah, sure, some super big megalith corp could build this, quote unquote platform overnight, but they don't have the trust, they don't have the transparency, and they can't build at the speed at which our startups do.
Let's talk to the LPs for a couple of minutes. So maybe why don't you share a little background of the profile of the current LPs in Render, and then maybe why someone else would want to be an LP in the future with Render?
Yes, we get this question a lot, Scott. It's super interesting because I'm an emerging manager, which means I'm only on fund less than 4. That's typically how the private markets take a look at emerging managers. We're coming up on fund 2, but our fund 1, you asked about LPs in our current fund. Because we're in the Midwest and South, we have a splattering of institutions, ultra high net worths, and first time LPs, by the way, and then just your kind of run of the mill high net worths. So we have everybody from 50 South, a subsidiary of Northern Trust, the $14 trillion asset manager out of Chicago. We've got a couple billionaire family offices, entrepreneurs that have made money. We even have one of my favorite investors. He sold his cotton gin for $400 million. And one of the reasons we were catching up over beers a while back, and I was like, Dave, why did you invest in us again? Like cotton gins and all this stuff. And he's like, Patrick, the things that you're investing in, if I knew and had the technologies like vSimple, which is creating a more seamless CRM and ops layer for middle market companies, he said, if I had some of those companies as technology components in my company, I would have been able to sell for $1.2 billion. And so I think the interesting, again, trend behind that is as we see this silver tsunami of the $16 trillion worth of wealth that's going to be transferred from one generation to next, those new buyers, whether they're search funds or they're leveraged buyout funds, or they're like my wife, purchasing middle market businesses, they're either at the edge of digital native, meaning they didn't grow up with a phone in their hand, but they grew up with AOL and squeaking in their ears while getting onto the internet. But they understand how digital transformation works and what can be really leveraged there. And so I think all of our LPs, whether it's an orthopedist, whether it's a lawyer, whether it's a middle market, founder that's exited, whether it's an institution, I think there are 2 main leading indicators that have really brought them over the edge. Number 1 is our thesis in our area of this middle of America, of this capital efficiency and price sensitivity and capital effectiveness. Number 2 now is we're top quartile, right? But number 3 really is they know what it takes from like a non-standard, VC bro to invest and back a GP like me, right? I didn't go to Harvard Business School. I don't have some top tier MBA, but I've literally lived it on the founder side. I then lived it on the fund-to-fund side. Scott, I thought when I was fundraising for my most recent startup, I thought VCs were just arrogant a-holes with no bosses. Turns out only two of those are true. They're arrogant a-holes, but they have bosses. And their bosses are LPs, right? So at the fund-to-funds, we probably saw, I don't know, Sarah or Tim could tell you this, but we probably saw 2,000 or 3,000 like legitimate like deals that we looked at, decks that we looked at. And only, at least during my tenure there, only committed to about 30 or 40 venture funds. And a big driver for that, not only from the LP perspective, from the returns perspective as well, was understanding how and where their, back to vision and intent, their vision, their intent, and their background and track record was going to get them to the next level. And you can even see that in some of our, our founders and how and where they, talk about us, right? There's amazing quotes from Steven about like, hey, I won't make it in this fund, but I'm super excited and a huge fan of Patrick and Tret because when we sell Forecaster for $1 billion, I'm going to be an LP in their next fund, right? Like that really means a lot to a GP. So I think the biggest thing for us is really nailing that understanding and being trusted, being transparent, and being communicative. Because the other thing, Scott, and you know this, I think last year, year before last, there was 1,800 fund ones, 1,800 new emerging managers that were created. Yep. And about 30% of them don't exist anymore.
Well, and it's interesting. That's the whole thesis of why I came up with this podcast. At the end of last year, this article came out that 75% plus of all the money going into venture capital funds were 15 or less. Yes. The names. And what I've realized is that a lot of the I've worked with venture capital funds from around the world, and some of these funds they're very good at selecting and companies and managing a portfolio, but getting the word out on who they are is something they don't do.
Yeah.
Well, Patrick, what are some final thoughts that you want to share with our listeners today?
Yeah, so I think I'll leave maybe dovetailing off of that. Look, and I've got friends at Andreessen. One of my classmates used to run their crypto side of the house, a guy named Alex Bruden, great guy, scaling a crypto company today. I've got friends at, Madrona, they just raised $770 million. I think that the interesting thing, by the way, look at Andreessen. Now they are a registered investment advisor managing all sorts of assets. For us, what it really comes down to is just the stats. Like emerging managers as a cohort, as a group, obviously I'm talking more specifically toward the top quartile folks like me, we produce the largest outsized returns for our LPs. It is much more difficult for an $800 million fund to 5, 7, or 10x their fund than it is for me and my little $30 million to be able to do that with. And so I think the other interesting thing too is we're able to shape and form and mold these companies from the earliest stages. So I'd say, look, if you're a founder or if you're an LP, make sure that you're aligned with VCs that are helping you get to that intent and helping you get to that vision, whether that's Render or somebody else. And by the way, the other caveat that I would make that I'd leave everybody with is only 1% of companies should take venture capital, right?
Amen.
It's not cool. Like it's fine. It's great. It's fun. I love what I do, but don't just take VC because it's a cool thing to do. Because that sets you and forces you on a totally different pathway. And there's a ton of businesses, again, like my wife's included, she'll never take venture capital for a warehouse and logistics company, and she shouldn't ever, but she's doubled revenue year over year. Yep. Like you can still do that in a middle market company. So
absolutely.
Thanks for having me, Scott.
Well, Patrick, where can they learn more about Render and yourself?
Yeah, so you can just go to render.capital. Tret and I are super open. My email is patrick@render.capital. And feel free to find and follow on LinkedIn. We try to be responsive to everybody and helpful wherever we can, because one of my favorite things, again, to do in this world, just like you're doing here, Scott, is connect people and help folks understand at least a little piece of the journey that I came from.
Fantastic. Patrick, thanks for being on. And for all listening today, We'd love you to subscribe to our channel, and I'd love to have your feedback. Again, thanks, Patrick, for being on our podcast today.
Thanks, Scott. Beat Navy.
I thought it was so interesting that he bootstrapped his first two and then, and then grew his other one a different way. So he's actually done it in both models. And I think that's really an interesting perspective.
Well, and that really provides a real benefit to the entrepreneurs because obviously, you have a lot of investors that start out as successful entrepreneurs, have an exit, and then decide to become an investor. And like you said, Patrick has grinded it out on his own, and then did it with what some people say in the industry is a more traditional sense. So he can really look at it from two unique perspectives.
Yeah, and being outside the tech hub, as he called it. But the interesting thing is, like, I have lots of contacts and other things in like Dayton area, Cincinnati, Cleveland. I mean, there is some massive money flow going through those areas. They are not, outside of it. They've almost got their own industrial hub.
Exactly. And I think that was the real intriguing part of this is that everyone likes to look at the coast for the entrepreneurs and the investors. There are plenty of excellent entrepreneurs and plenty of investors in the Midwest and specifically, Ohio and Cincinnati.
Yeah. And what do you think of being in that top 25% and like when you're an emerging manager, when you're in these emerging funds and they're shifting into that high percentage, is there a difference for an LP coming in?
Well, absolutely. Because at the end of the day, an LP is looking to increase their returns and their returns are and when you invest in funds, is clearly based on the performance and the results of the manager of the fund. So it's kind of like the difference, in being investing in the S&P 500 versus investing in, a $5, penny stock. I think the reality is, that's a demonstration of managing the portfolio and making the picks.
Yeah. And I also thought it's really interesting that he was saying that Midwest mentality is that they have a more propensity to like bootstrap it, make it work, make a win there, right? Because they don't have as many options. So they've got to make do with what they have, according to him. But I think there's a lot of options there. When he was talking about the big companies in and around what they're doing, FedEx and Amazon and Procter & Gamble and all these other giants right around them. And in the medical space, there's a huge amount. That, I don't think they are the underdogs.
No, I think there's these hidden pockets of communities. It's like, I'm in St. Pete in Florida. I think that's a hidden community. Decades ago, Austin was a hidden community. And I think the reality is, and think, that Patrick mentioned also is that valuations are better. If you could take a company in Cincinnati and put it on the Embarcadero in San Francisco or put it on Sand Hill Road, down in the Bay, and you probably get an uptick in valuation. So that's also providing a compelling argument for LPs that they know he can buy the same technology or as good as the technology, relatively speaking, on the cheap.
I think the one issue that I was sort of thinking in the back of my mind, because, we're here focusing on these emerging managers and trying to say, how do they make the case to future LPs? How do they make the case to future founders? How do they get the attention that they deserve for the returns that they're achieving? But when they're a generalist, I think it's actually really hard, Scott, because as a founder, I don't know whether or not I'm going to be a right fit for them. And I think it makes it harder for me to reach out for them to get notice of these deals that are going on or these companies that are available to invest in.
No, I would agree. And I find that's been the recurring theme of the folks we've been interviewing over the last several weeks and months is that they had to find a niche and get really good at their niche. And sometimes those niches are industry specific. Sometimes those niches are geographic specific. So get to know your lane well. And that's what Patrick's doing.
Right. He said, we're focusing on this and we're focusing on this area or these companies that you might want to sell to. So those might be good too, whether you're outside of the Ohio or the greater Ohio area.
Exactly.
So interesting. Well, I learned a lot from Patrick. What about you? Any takeaways that you want the audience to hear?
Well, I think the main takeaway is that there's a lot of country between the coasts, and there's a lot of good companies between the coast, and there's a lot of good managers between the coast, and Patrick's one of them.
Absolutely. Well, we'll be back next week with some more emerging managers, right? And I am so looking forward to our conversations about them because I'm learning something every single week. And I hope you listeners out there are too.
Awesome.
Join Scott Kelly, Tracy Hazard, and their high-performing capital fund manager guests next week on the Emerging Managers Podcast. Don't miss our upcoming virtual and live VC Fast Pitch and podcast events. For more details, background on our guests, or an application to be our next guest, visit emergingmanagerspodcast.com. Don't miss out on shaping the future of venture capital and entrepreneurship with us by joining our robust community of innovators and investors today.